Okay, so welcome everyone here in the room. Welcome everyone online. It's our 233rd Reading Online Sports Economics Seminar. It's great to be a hybrid. One of the very few times we've done it hybrid. Diego Escobari is with us. It's great that Diego's taken the time to stop here on a whistle-stop tour of Europe, heading down from Durham and on his way to Serbia for a conference next week. And the point worth making is that if anyone is popping through Reading, you're always welcome to join us, and you can enjoy our campus, as Diego's been enjoying our campus this morning and the rest of today. Diego's going to talk bridging prediction markets and asset pricing, information parity, and a favourite long-short bias. He's happy to take questions as he goes along. So those of you online, raise your hand. I will also be joining from my laptop, so I'll be able to keep tabs if there are questions. And otherwise, we're going to wrap up ever so slightly early today, just because I've got a train catch. And so we'll wrap up at about 10 to 4 UK time, so that's in about an hour and 20 minutes. So, Diego, all yours. Thank you very much.
Thank you, James, for accommodating my talk, for giving me some of your time to go into the fascinating world of prediction markets. Thank you also to the people who are joining online. So what happens with my research is that I always jump from data set to data set, trying to find something that is fascinating, and I always fall in love with new data sets. And the last year or so, it has been constantly on the news, these prediction markets, because it has been very, very popular in the US. And what happens with prediction markets is that these Polymarket and Kalshi, they want to give the impression that they are being transparent, that they are fair to investors or people who are betting, and they are allowing people to get the data set. And they say, hey, this is my chance to get into these very nice data sets. And that's how we ended up working on this paper. So Bakir, it's a PhD student in finance. So he brought his finance before going to the PhD. He worked a number of years in stocks. So he's very familiar with Black-Scholes and the finance side of the paper. So it was a very good match when we started working on this prediction market. And of course, what happens with prediction markets is that it's huge in sporting events, because what happens is one key element of prediction markets is, okay, we need an event, and probably the number one place where you can find events is in sports, football, soccer, basketball, because you have a clear event, and then you have a clear yes-no. So you can basically bet, hey, will the San Antonio Spurs win the NBA, and then you have a clear yes/no and a clear deadline. So that's basically perfect for prediction markets. The key contribution that we have in this paper is that we have information flowing from the stock market to prediction markets, and we're trying to build this bridge and see how stock markets are helping us predict the outcome that we have in prediction markets. So let me get to the first slide. So the contribution, the outline of the contribution, the presentation is pretty much the same as in the paper. It's just first motivation, we have some theory, and we basically have three big contributions. One would be the behavioral element behind prediction markets. So it was done before. What we do is basically replicate some results that have already been there for prediction markets and for betting markets. And that's helpful because it allows us to control for them once we move into learning. That would be the second big contribution. And when we see the competing factor between prediction markets and the stock market when trying to forecast the outcome of events. So that would be the encompassing regression test. And at the end of the paper, we have some simulations that help us validate the empirical specifications, and we have some counterfactors. So very quick. So this is what happens in academic presentation is that we always go, hey, this is the killer, right? So this is so you don't need to go all the way until the end of the book to know who the killer is. So the contribution of the paper is essentially we build this bridge between prediction markets and the stock market, and we see how information flows from stock markets to prediction markets. Then we find this evidence of favorite long shot bias. That is basically the behavioral element behind prediction markets, where humans, we don't really process linear probabilities exactly as like math would predict, but we kind of overestimate small probabilities and underestimate high probabilities. So we formalize this and we estimate a structural equation based on this Tarvesian-Kahneman probability weighting. We also document some temporal learning, and then we have this competing between stock and prediction markets to see which one can predict best the outcome of prediction markets. And we have this, what we find is this 50-50 informational parity. And at the end, we go with simulations and counterfactors. And that's like a very, very quick summary of the paper. Now, I'm not really sure how familiar you are with prediction markets, but this is like my friends in the US are like, since I was presenting this in the UK, I like football is like huge, like okay, in the US we call it soccer, but that's like this is the best time of the year probably to present this type of papers, because we're all like trying to watch the soccer game. Like last night it was 2 a.m. in the UK when Mexico was playing with South Korea. So the schedule is not the best, but these are perfect for prediction markets because we have a well defined. You can say, okay, you can place a bet on whether England will beat Ghana, right? And then what also happens is that you see the dynamics as you approach the game. So this is, I got this screenshot on the right-hand side prior to the start of the World Cup. So it might have changed based on the most recent results of Ghana and England, right? But the key idea is that you do observe some dynamics, and in prediction markets, you are allowed to buy shares, right? So the idea is that very similar to stock markets. In stock markets, if you think Amazon is going to be doing great in the future, you might want to buy stocks from Amazon. If you're holding stocks from Microsoft and it's not doing that well, and your expectations that earnings will not be that great, you might be willing to sell. So something similar happens with prediction markets. So in prediction markets, some people hold a long position, some people hold a short position, but you observe these dynamics, and people will be trading, and they trade shares that are priced between 0 and 1, right? And this has been shown, we modify a little bit the theory to show that there's the weighting functioning, the human element behind the probabilities, but in general, you can think of the prices as predicted probabilities. So whenever you see this figure and you say, okay, it's around 0.74, I think it's behind this part. It's fine. So that's good. So if it's, let's say, 0.74, you can read this 0.74 as the chance that England wins the game is 74%. And then you're paying, if you're buying a share, you will be paying 74 cents per share. If England wins, you win $1 for every share. If England doesn't win, your money is gone, right? Very similar. Oh, and probably the key element, the key difference between prediction markets that is different from the stock market is that the stock market, the price goes up and down, and every quarter you see firms reporting earnings, so the prices will be following fundamentals. But here, this is a zero-sum game. So if you're making money, someone else is losing money. So there's no, I don't know, earnings behind the price. Yeah.
I don't know so much about how these markets work, but are you typically allowed to sell your position?
Yeah. You can buy or you can sell. Yeah.
Okay, so if I am given a contract that pays off, this much if England wins, then I'm allowed to resell that to any other better.
Yeah, or you can always buy the yes or no, right? So you can always buy the no position, right? So you can because you can easily diversify and bet, let's say, England wins or bet Ghana wins, so you can balance we don't do this here, but yeah, probably if you can if there are correlated events, you might be able to probably, let's say, try to reduce some risk based on some putting some weights on your portfolio, right? Yeah. So this beyond the sporting events, this has been very popular in trying to predict macroeconomic indicators, predicting stock prices, or prediction election winners, or even like top culture outcomes, like with Taylor Swift get married this year, or like some of them are extremely controversial. I think someone was betting in some like football or some football game. There might be like someone naked showing up on the field, and the person placed a bet, and he himself showed up on the field and made a lot of money and then had to pay a fine, but made a lot of money on prediction markets. Inside trading, as I'm gonna explain later, and today is also a big problem in these prediction markets. Anyone online, like you can stop me at any seconds if you have any comments or questions. So we focus on this type of events, the one I'm showing down here, like will Amazon close or will Amazon stock close above a particular value, right, by the end of the month. So why are we focusing here is because if we focus on, let's say, England versus Ghana, we do observe some dynamics, but we don't really know what are the key factors behind the dynamics. It's very difficult to pinpoint. But if we go to these type of events, like with Amazon price close above, let's say 300 by the end of the month, we do observe the Amazon stock price moving little by little every day where the stock market is open. So we basically have a continuous flow of information every day that will allow us to compare poly market and the stock market for multiple operations prior to the end of the event. That's why we focus on this type of events. I have to show this one. I know James has a competing forecasting framework. So this will be prior to the start of the World Cup, which are the teams who are most likely to win. I think England is number 3 at this point, probably when it moved up, right? I don't know. So this is another example in which prediction markets clearly show how the price move up and down as more information arrives. The reason why I'm picking this is because I live close to San Antonio, close like Texas type of close. It's still 4 hours away, but for Texas, it's like this is the biggest city that is closest to where I live. And this is what prior to the last game. So New York is already won. But what I like about this figure is you can easily see how it jumps up and down as this information gets into the market, right? So like if New York Knicks won one of the games, the chance that they win the championship immediately jumped up, and the chance that San Antonio Spurs win immediately jumps down. So that's a very clear example of how prediction market prices change as new information comes to the market. Very similar to what you would see in the stock market. In the stock market, whenever you see, let's say, Elon Musk tweeting about, let's say, the stock market or about Tesla, you would see the stock price of Tesla moving up and down. Or when you see earning announcements, that's also like big jumps, information flowing into the stock market. So, and in this particular case, there's $814 million. So there's clearly very big incentives for investors to put a lot of effort into trying to come up with the best probability possible. Something that is still currently in debate is like, is this price really capturing this wisdom of the crowds? Can we say that overall, is this price really telling us this wisdom of the crowds? There is some work related to this. We don't do this particularly in this paper, but the debate is there. Now, why is that we're working with prediction markets and why it's a big deal in the last 1 or 2 years? The 2 key prediction markets in the US are Polymarket and Kalshi based on volume. Polymarket launched in mid-2020, and they are regulated by the Commodity Futures Trading Commissions, and they are regulated as event contracts. So the funny thing is that at the beginning, they were branded as betting markets, but then realized that there was a huge backlash because sport betting is illegal in 11 states. But guess what? If you're in one of these 11 states, you can still log into your computer and still trade. So there's still a lot of debate on whether we should be allowing some of states to bet or to trade or to place bets on or to buy shares in these poly markets. This is an ongoing debate, but what is very clear is that this poly market and Kalshi moved away from claiming that they are betting markets and are more like buying and selling shares of event contracts. So that's the key element. Poly markets started working without a permission, and they were fine in 2022, but they were okay with paying the fine, and they kept operating. What you could see here is that at least in poly markets, some key elements are sports, crypto, not much finance, and then politics. If you see Kalshi, I think over 20%, over 80% would be sporting events. So Kalshi is much more, it's much bigger in sporting events than poly market. Last slide on the motivation. So poly market is huge and it has gathered huge political backing in the last year or so. So Donald Trump Jr., the son of the president, is strategic advisor of Kalshi, and is also one of the investors in poly market. So that has made basically push the momentum on these prediction markets. And what also happened in 2024, these prediction markets were predicting that Trump would win when some of the pundits were predicting that Kamala Harris would win. And guess what? Like prediction markets appear to have been more precise on predicting the winner. And we also had in 2025, the New York Exchange parent company invested in poly market. And so this is the building of the New York Stock Exchange, and they made a big deal about poly market. And even like very recently, last year, November, Google started showing real-time odds of poly market and Kalshi on their search results. So now our contribution, probably one of the closest on the, when we assess efficiency, would be this economic journal from paper from James, where he shows that betting prices update swiftly to new information. So we don't directly test this idea, but we still check how information flows from the stock market to the prediction market. So prediction markets have been used to assess performance of, betting in sporting events. They have been used to, let's say, predict the outcome of elections, macroeconomic expectations, repeatability of scientific research. And more recently, they have also been used to extract real-time expectation of Federal Reserve decisions. So if I have to summarize the literature here, there has been some work, let's say 10 years ago, 15 years ago, but now there's a new big wave of new papers that are taking advantage of these poly market and Kalshi data sets. So there's a lot of papers that are still working papers 2026, late 2025. So we hope to be, in this paper, we hope to be one of the early papers that makes a contribution. And one of the key debates is this wisdom of the crowds. So the idea would be that if the price is capturing the wisdom of the crowds, but some work has been showing that that's not the case. It's usually a small group of investors, the ones that are ripping off most of the benefits. We also contribute on this favorite long shot bias, that is the behavioral element behind how individuals assess probabilities. And the main reference there would be Travesky and Kahneman in this seminal 1992 contribution. And the motivation would be the cumulative prospect theory. The third big contribution is also related, the second big contribution is related to learning as we approach the end of the event. So in this case, there has been papers that look at learning in asset markets, in perishable goods. And here I think we are one of the first to to show that learning occurs in these prediction markets. The third big contribution is related to how the stock market information help us predict the outcoming prediction markets. And it's basically, we show that information is flowing, and this literature is linked to this Minzer and Salnowitz equation and this Fair and Schiller equation, where you have different forecasting models and you're trying to measure the contribution of each of these forecasting models. So let me jump into data overview. So we have only a few months of data. Why November 2025? Because prior to November 2025, Polymarket didn't have this type of events. So they are very, very recent. So we have a few months of data, and we focus on this closed above type of contracts. So the idea is that this closed above type of contracts is, will the stock market of Amazon or Microsoft end up being above this particular level by the end of the month? So if you have some financing trading or asset pricing, you will immediately recognize these as, hey, these are option contracts. And then we can use Black-Scholes to estimate the probability that the stock of Amazon will be greater than the strike price by the end of a particular date. So that's what we're taking advantage, and we think we're the first ones to do it, which is like, we're very happy when we figure this out. So we can basically link the stock market and Polymarket, or the stock market and prediction markets, based on the fact that some events have a very clear analogy with these option prices in finance. So when we figured this out, like, hey, wait a minute, so then who came up with these events? I'm sure that someone in Polymarket who came up with this event said, hey, I'm gonna use Black-Scholes to try to make some money and come up with these events. And probably some people will trade without knowing Black-Scholes. So maybe they might be using Black-Scholes to take advantage of probably less informed traders, right? Because what happens in Polymarket is that there's a lot of people trading, and typically on the news, this is not specific academic papers. What has been showing on the news is that there's a lot of males, typically between 20 and 30, trading in Polymarket, and they might not be very sophisticated. So they are not as sophisticated as stock traders. So they might not be aware of this analogy between the stock market and Polymarket, and they might be losing money here at the expense of more experienced traders that might be coming from the stock market. So we focus on Magnificent Seven. So this is Apple, Amazon, Nvidia, Microsoft, Google, Meta, and Tesla. And those seven account, in terms of market capitalization, those are about a third of the S&P. So this is pretty big. And for the price, we basically, because we have multiple transactions within the day, we use the weighted, the volume weighted average price. So we have a specific price within the day. Now, we need to compare the Polymarket price with a price that will be coming from the stock market. And the way we do it is we follow Black-Scholes. So let me give you the intuition of how we calculate the Black-Scholes. So I'm just going to go with intuition. So the key idea is that the stock prices evolve following a geometric Brownian motion. So this is the stochastic difference equation. And these are not our equations. We're just borrowing Black-Scholes. And this is basically borrowing the Black-Scholes formula. But the intuition is very straightforward. So if you're at some point zero, so the stock price can evolve, let's say, based on this geometric Brownian motion. And the idea would be, what's the probability that the price is above, let's say, 140 by this point in time? You can easily calculate this by taking into account the drift, by taking account the variance. So that's basically the idea. Then we retrieve the probability using Black-Scholes, given some variance, given some drift. So the intuition is pretty straightforward. And then we're borrowing this Black-Scholes formula to come back and retrieve the probability that will be coming from Black-Scholes. I have the link here that will take me back to to the data overview. So sample, we have a bit more than 20,000 observations. We also restrict this to align to the New York Stock trading days. So we're dropping weekends. Now, summary statistics. So the key dependent variable that we have would be the resolution, 0, 1. And the resolution would be 1 if the stock price is above the strike or above this given $300 or $350. So that would be yes, no. We have the polymarket price. We have this Tversky-Kahneman price that after estimating the Tversky-Kahneman equation, we filter it from using the polymarket price. So it's going to be clear in a minute how we get the Tversky-Kahneman price. Black-Scholes and the GBM, this geometric Brown motion price, those would be coming from the finance literature, and we're filtering those from the price that is coming from the stock market that is directly comparable to the polymarket price. So that would be one key contribution of the paper. And the rest is just typical variables that you would see in the Black-Scholes literature. Managed days to expire is just how many days away we are from the end of the event. We have volume and then realized volatility at 7, 30, 60 days. And we also have returns, but those they were not significant in the regression, but we still wanted to keep them there. So what's the information?
Can I ask a question?
Yep.
So you're using daily data and like end of day or middle of day, beginning of day, how?
Oh, so we're using, this will be daily data. Mm-hmm.
Okay. And you're using the data from the end of the trading day? I mean, how?
Oh, for the stock market, we have end of day, then we have a close price.
Okay.
Yes.
And for polymarket as well, like the price at the time at 4 p.m. for
within
whatever.
The day. We have within the day, we have like the average. So yeah, that's a very good point, because at the end, we're basically capturing and saying these are contemporaneous prices, right? Now, there might be like, what we don't have here is like, in which direction information is flowing, because it might be that some of the trades are before the market closes, some of the polymarket trades might be before, some of the polymarket trades might be after. But the idea would be they are within the same day.
Mm.
Yes.
But you could get the polymarket at exactly the same minute in time,
yes.
What the price is at exactly the time of closing, right?
Exactly. We do have it, but we aggregate at the day level. So probably a refinement of the regression would be if we keep track exactly of the timing of the trade. Mm-hmm. Yeah. And what is interesting about polymarket is that you also have the idea of the person making the trade. You have the volume, you have the identity of the person who trades. Of course, one person might be able to have multiple accounts, right? And then you won't be able to know if the same person has multiple accounts and where they are trading. So probably a very sophisticated trader might have multiple accounts. But at least in principle, because you have the identity, well, of course you don't know the name, but you have the number, then you can see if this person has been betting before, and if in previous trades they have been mostly winning or mostly losing. We don't use that information in this paper, but probably that might be useful to test other hypotheses. Yeah.
Okay, thank you.
Mm-hmm. So we have contemporaneous signals, at least that's how we treat them in the regressions. So one that is coming from the stock market, we call that external signal, that is basically capturing the true plus some noise. And you have the investor-specific signal that will be the polymarket plus some noise. So it is the true, the polymarket, and some noise. And the idea would be, after doing some math, each investor will be having basically posterior probability that is a weight between these two. So this is just how each individual aggregates information. In this slide, very quick, what I want to emphasize is here is the first step is to take into account this behavioral element in how individuals assess probabilities. So we're using this weight function, and the idea is that the weights are just modifying the true probabilities. So individuals know what it's 0 and 1. And this basically, instead of this weighting function, instead of going through the 45-degree line, the idea would be they overweight small probabilities and underweight large probabilities, but the weighting function is basically increasing and increases fast at the beginning. It has a single crossing point, or I probably should say it this way. It has a single crossing point, and then for larger probabilities, they underweight large probabilities, and then it hits the 45-degree line at the 1 point again. So it's going to be these three axioms. It's going to be very clear once you see the weighting function in the graph. But this is a little bit to formalize the idea of cumulative prospect theory. So in terms of how do individuals trade, the intuition is very simple. So this is constant absolute risk aversion. This is just for simplicity. So individuals maximize utility. They take into account the weighted probabilities. They have some wealth. If they win, they will win $1 minus the price that they paid, let's say 74 cents in the England-Ghana game. If they lose, they just lose the amount of coins that they bought times the price they paid. So first order condition, and then if we played it with the marginal utilities, so this would be the demand function. And what I wanted to show you is that the demand function depends on the perceived mispricing, right? So if you think that the probability that England win is 0.8, but the price of polymarket is 0.74, then you would buy. And then it's also adjusted by the risk aversion and by some measure of volatility. But it's the key element here would be that the perceived mispricing, that's what is driving people to buy or sell. Now, at the aggregate level, because we have some taking a short position or some long position, the sum needs to be equal to 0. And if we do a little bit of math in terms of the market clearing price, we would have that the polymarket price is essentially, you can read this as a probability. This has been done before, but here we augment the existing theory with the fact that there's this behavioral element behind, and it's the weighted probability that matters. So this would be the baseline regression. So this is where, let me focus on the intuition. So the left-hand side will be the 0, 1. So this is whether, let's say, if England wins 1, England loses 0, and this is the polymarket price. And we can use this regression, and we do have some controls in this matrix. X will be the matrix of controls. So we can run in this regression, we can test for market efficiency if the slope is 0 and beta is equal to 1. So we're moving along the 45-degree line. So that would be the first formal test. Now, to test for the existence of this favorite long shot bias, what we do is this linear model, we will try to make it nonlinear. So the interaction terms, of course, is not perfect because we're trying to capture a nonlinear model with a linear model. Later on, we have some simulations to try to motivate that this is the correct specification, but it has some assumptions, but we're still trying to capture a nonlinear model with an interaction term. And the key idea here is that we break down the sample in two, whether the price is below some level and whether the price is above some level. If it's below some level, this dam is equal to 1. If it's above some level, this would be equal to 0. And the idea would be we just look at the interaction and see if beta 1 is different from 0, right? So if the market is, let's say, if it doesn't matter whether the probability is big or small, so this would be, let's say, if it's small, it's 1, if it's big, it's 0. So if it doesn't matter probability being big or small, the margin effect is the same, we would expect this beta 1 to be 0, right? But if it's not 0, it basically means that there's some nonlinearities in how individuals behave. So that's basically the idea. Now, if we just plug the information that we have from body market, where we have the predicted probability and the realized frequency, this is what it's showing, right? So now the way this works is, if you're in the red portion of the graph, basically, if the predicted probability is 0.4, once you check the realized frequency, you should have, if everybody's perfectly rational, you should have that happens 40% of the times. But when the predicted probability is 0.4, you observe that happening less than 0.4 of the times. So there's some problem there. And the reason why it happens is because people overestimate small probabilities. So when they trade at 0.2, they believe that the chance that they win is more than 0.2, or when it's 0.3, they believe that the chance that they win is 0.3, but the truth is that that's not the case. It's just, let's say, less than 0.3. So this is capturing this Tversky-Kahneman cumulative prospect theory, where individuals don't perfectly understand probabilities, but overestimate small and underestimate large probabilities. And this figure is capturing this idea of this long shot bias, that if it's a small probability, it's a long shot, they overestimate, and if it's a favorite, they underestimate. So that's the basic idea, and that's what we formally want to test with this regression. Now, in the regression results, first, without interaction, we have column 1 and 2 are basically with no interaction, just the first equation I was showing 2 slides ago. Can we show that there's market efficiency? If we formally test slope 1, constant 0, we find that we reject market efficiency. So there is some behavioral element that is preventing us from market efficiency. Now, once we take into account this favorite long shot bias and this interaction term to show that there's some non-linearities in the way people assess probabilities, we find evidence of this long shot bias with interaction term being statistically significant. That is basically the slope is smaller for small probabilities and is larger for large probabilities. So that's what this regression is saying, which we interpret this as evidence of this favorite long shot bias, or evidence that we have this behavioral element behind people assessing probabilities. Now,
Diego, Diana has a question.
Yes.
Yeah, sorry. No, I was just wondering whether, so if you put up the graph that you had before, like with the shaded areas, yeah, this one. So I'm not that familiar with this literature. It seems that the area of, underestimation or overestimation is quite large. I would have expected like, or how does it compare to sort of other contexts where people have, estimated these curves? I would have expected, yes, at very low probabilities to be, for there to be underestimation, but, between 0.2 and 0.8, which are not sort of, very low or very small probabilities, things to be much closer to the 45-degree line. And I don't know if that my expectation was correct, or is there something unusual here?
Oh, that's a good point, because I think what people have been doing is estimating the Tversky-Kahneman functional form to capture this nonlinear relationship. We estimated and we find that it's 0.81, and we can compare the 0.81 with previous papers, and that's something that we don't do, and probably we should do it, right? Now, 20-some years ago, back at home when I was in my undergrad, we had to write a thesis. And back then, I was working on tax evasion. And this curve was big on tax evasion. And there was a paper from Bernasconi, who was Journal of Public Economics, that was using this exactly nonlinear relationship to explain why people pay taxes. And the basic idea was the probability that you get caught evading taxes is very low, yet individuals still pay taxes, and they would need to have excess risk aversion to observe the level of taxes that they pay. And what he said is it's because even though the probability is small, they overestimate this probability, and that's why they pay the level of taxes that they pay. So this nonlinear model has been used widely, not just in betting markets, but whenever there's decision under uncertainty. So what we can certainly do is compare the 81 that we estimate with other papers to see how it compares. Yeah.
Okay. Yeah, that would be interesting. I mean,
Yeah.
maybe it's similar to whatever others have found, but I just want to.
Formally speaking, we know it's not on top of the 45-degree line, but how severe the problem is, I don't know. But yeah, it would be interesting to point that out in the paper. Yeah. So in this regression, we are able to show the behavioral element exists, but the threshold is arbitrary. So what we do to try to solve the fact that the threshold is arbitrary is play with different thresholds and run the regression multiple times and test for market efficiency multiple times. And what we find is, again, it's not correct to read exactly, okay, this is the threshold that makes people rational or not rational. But when the probability is small, we have a very clear evidence of favorite long shot bias. If it's 0.2, 0.4, probably. And at some range, it's not different from the 45-degree line. So if we try to link this figure with the previous figure, there's going to be some range in this nonlinear relationship where we're very, very close to the 45-degree line. So if you plot this with the confidence bands, there's going to be a range in which we cannot claim that individuals are not rational. It will be still close enough to rationality, but the problem typically occurs in very small probabilities. So that's the key message here. And we do this by just testing with different thresholds and coming up with the F statistic and comparing the F with the critical value to find what we have. What we claim is like the rational core that would be probably where the probability is around 0.6, 0.7, 0.8, and the favorite long shot bias typically occurs with smaller probabilities. Now, to later on in the estimation, what we do is we want to control for the fact that there's this behavioral element. And to control for the fact that we have this behavioral element in which individuals assess probabilities, we estimate this Tversky-Kahneman functional form. So this functional form, it's basically an inverse S relationship that basically the input would be the true probability, the output would be the observed probability. So we need to invert it to be able to use it, but this is the functional form. If delta is equal to 1, people are perfectly rational. So if you plug delta equal to 1, then you will have that the true probability is equal to the observed probabilities. But for any delta less than 1, you have that this favorite long shot bias exists. If we had delta equal to 1, then the light blue line would be on top of the 45-degree line. And the degree at which the light blue line, the curve, moves away from the 45-degree line, that would be if this delta is less than 1. So what we do is we use nonlinear least squares and break down the sample in bins, and we find that this delta is less than 1, which is consistent with the previous regression. And the formal test for efficiency would be if delta is equal to 1, and we reject delta being equal to 1 across different specifications. So in this figure, it's the x and the vertical and the horizontal axes are different, but the message is still the same, that people overestimate small probabilities underestimate big probabilities, and if there's perfect market efficiency, will be on top of the regression line, right? On top of the 45-degree line. Here, what we have is this is the observed probability. This would be the true unobserved probability. So what we do later in the regression is that given that we have the market price, we transform it to come up with a version of the true probability based on Kahneman and Tversky and Kahneman. So the second big idea that we're testing in this paper would be the learning element, right? So we have that event, England and let's say, and Ghana are playing a few days. Is there a learning element as we approach the day of the game? Or in the stock market, if we're telling the stock of Amazon is above 300 by the end of the month, as we get closer to the end of the month, is there a learning component? Okay. So what we do here is that we're allowing the weighting function that we saw a few seconds ago to depend on tau, and tau would be time to the event. Okay. So what we need to do is to invert this function invert this function, and once we have beta, we take the limit when tau is 0. So that tau is 0 is basically as you approach the day of the event, we expect the marginal effect to be 1. So if there's any deviations away from rationality, we expect people to be fully rational exactly the time of the event. So that's basically the idea, because people are learning more about the event as we get closer to the time of the event. Now, the way we test this is also with an interaction variable. And here we're using tau, and tau is time to the event, and the dummy would be if tau is greater than the median tau. So median tau, I think, is around 6 days. So if days is above 6, this would be 1. If it's below 6, this would be 0. So what this interaction term is capturing, it will be if we're far away from the event day, though this is 1, so the difference would be, the marginal effect would be beta 0 plus beta 1. If we're close to the time of the event, this would be 0, right? So this is not true, so this is 0, this part disappears, so the marginal effect will be just beta 0. So what we find is that beta 1 is positive, and we're calling this price compression at a distance. But in addition to the learning, what we're also testing is this terminal rationality. So as people learn, the question in this terminal rationality is, by the time we get to the event, will we have that people are totally rational? So if beta 0, so if we're already close to the event, this part disappears. So will we have that beta 0 is equal to 1? So that would be our definition of terminal rationality. So that's something, one element that we test. So in the regressions, we have a number of results. First, we have the discrete learning is, the dummy is far or close to the final day of the event. So that's column 4 and 5. And we also have it, instead of interacting it with a dummy, far or close, we're interacting it with a continuous variable. So we call it continuous learning, column 1, 2, and discrete learning with the dummy 4 and 5. But the idea in both cases is exactly the same. Now, the interaction variable is positive for column 1 and 2, when we have the continuous learning, is just tau. And when we have a discrete, the dummy, column 4 and 5, is basically capturing still significant, and it's also evidence of some learning. So across columns 1, 2, 4, and 5, there is evidence of learning. So that's what we find. Now, columns 3 and 6 are different, okay? So how are 3 and 6 different? What we do is we come up with a rational adjusted polymarket price. So if I go back a few slides ago, So we basically said that people don't know how to assess probabilities. There's this behavioral component, and we estimate this Tversky and Kahneman. And now we say, okay, if we know this blue line, why don't we use the polymarket price and transform it so that individuals are rational? So under the assumption that this Kahneman-Tversky probability weighting works, and we use the coefficient that we estimated, let's run the model again. So that's basically columns 3 and 6. So this regressor PMTK is the price, polymarket price, Tversky and Kahneman. So this is after we adjust the probabilities to take into account, to try to make the individual rational, to try to rationalize the probabilities, we find that the interaction term is not significant. And we have that the probability is close to 1. So when we test terminal rationality, we do find terminal rationality in columns 3 and 6, and we do find that the interaction term is not significant, column 3, not significant, column 6. So the way we read this is that, yes, there is some learning, column 1 and 2, or column 4 and 6, but the learning disappears once we force individuals to be rational. So the learning is coming from, they're basically eliminating the irrational component or the behavioral component. So that's the way we're reading these results in the table. So it is basically, yes, learning exists, but it's the behavioral element that disappears as you get closer to the day of the event. Do you have any comments or questions online? Are you good? I think we're good, right? Now the final version of the puzzle here. So this is where we were very excited to bring and to basically bring information from the stock market to the prediction market, right? Because we're using these Amazon, Tesla specific events. Will the price of Tesla be above this level, right? So then we use Black-Scholes to come up with this P external, right? So if we want to predict what is the final outcome of the event, we're using the polymarket price that we observe from the polymarket website, and we're also using this price that is coming from the New York Stock Exchange after filtering using Black-Scholes. And then we're running this regression plus some controls. And one argument here is the polymarket price should already contain all the information, right? So if people are, let's say, very sophisticated researchers, really know what they're doing, this shouldn't matter because they have already looked at the stock price, they have already filtered it with Black-Scholes or other models, and then only the polymarket price should be important, and only the polymarket price should already contain all the information available in the market, like market efficiency, like pharma and claiming, okay, the price already contains all the information in the market. So the prior was PM, the beta PM should be statistically significant and probably close to 1, and the beta X, that is basically capturing the information coming from the stock market, should be 0. Now, when we run OLS, you can read these OLS coefficients as signals to noise ratio. So that's an additional element of using OLS to estimate this model. Now, the regression results, what they are showing us is that there is valuable information coming from the stock market. So there appears to be a lot of people trading on this type of events on polymarket that are not fully aware of the stock price, or not using at least Black-Scholes to bring information from the stock market to polymarket. So the coefficient on polymarket is 0.5, around 0.5, sometimes a bit more. In this geometric Brownian motion, uses a slightly higher drift. That would be the big difference. And then the price that is coming from the stock market is also 0.5, which is very different from 0. So what these regressions are saying is that there is information that is coming from the stock market into poly market. And the effect is statistically significant and pretty big, and probably, I think, as big as the one that is coming from the poly market price. And we formally test 3 different hypotheses. One is what we call the information dominance test. So information dominance would be the price from the stock market has no information, so everything is coming from poly market, and then we reject this hypothesis. So we do have information that's coming from Black-Scholes, or that is coming from the stock market. So now information complementarity would be if the sum is equal to 1, right? So because both of them are prices, we can say, okay, if both of them are prices and we have the outcome needs to be 0, 1, then the sum probably is close to 1, but we also reject this one. So the 45-degree line, the empirical version is a bit steeper than the 45-degree line. So that would mean the fact that the sum is above 1. And the last one that basically gave the name to the paper is information parity, which is basically showing that the information is has about the same weight. So the 0.50, let's say, if you look at column 1, the 0.51 effect of poly market and the 0.52, that is basically the effect from the stock market, is about the same. So information parity is basically, can we claim that the marginal effects are the same? And when we run the F-test, in all the cases, we cannot claim that the effect is different, right? So that's the formal test. And then we call this information parity. Now, if we look at column 3 and column 6, this is when we use the Tversky-Kahneman transformation of probabilities. And what column 3 and column 6 are telling us is that even after controlling for this behavioral element, that people don't weight probabilities linearly, but there's some behavioral element, even after controlling for those, we do find evidence of information parity, and we also reject the first 2 hypotheses.
So, am I right in interpreting this as also there's information contained in the poly market betting that could also be informative about the stock price that's not captured by the Black-Scholes equation?
Yeah, yeah, so theoretically, that would be right? So it's, if you are a trader in the New York Stock Exchange, in theory, you could be bringing information from poly market to the stock market, right? So at some point, my co-author was telling me, oh, let's make some money. Because if you look at these numbers, this really looks like we could make some money. Like, they just look at the New York Stock Exchange stock price, they look at the poly market price, see any differences, we use Black-Scholes, and let's start making bets. And then, of course, my response was, this is risky. On average, yes, you will make money, but in the process, you will sometimes win, sometimes lose, right? But in principle, if you run this regression, yeah, there is information in poly market that is not contained in the Black-Scholes as well, right? Now, because the stock market is so big, we're basically saying, okay, it's a stock market information flowing into poly market, right? I would doubt that it's the poly market information flowing. Probably you can run something similar, like can this poly market helping predict the stock market? Given the size of poly market, I wouldn't see that to be the case, right? But yeah, here it's based on these regressions. Yeah, the poly market is not 0, so it appears like information is coming. There is information in poly market, and there's also information coming from the stock market, right? Yeah. let's see if yeah, I'm not willing to put bets on this one yet. So my co-author was like very like, hey, let's make money. No, no.
You're just gonna sell this to a hedge fund.
Oh, well, I have some counterfactuals that in theory there's also a way to make money, but I'm not doing it. I'm not doing it. What happened is that I was working on some peer-to-peer lending a few years ago with one of my co-authors, and I lost a lot of money there because there was this lending platform where you lend money across the world, and this like it's based on like honor, right? So you lend money and they're supposed to pay you back after a couple of months. So I lent a lot of money. I never saw the money back because it has some lending, and then you're lending also with the chance that they don't pay back. So it's like lending plus like altruism component that you know that you might not see the money back. So yeah, I didn't see my money back in that one. And the problem is that I was not even testing that hypothesis, so that's even more painful. Okay, so to motivate the empirical specifications, then hey, wait a minute. So the equations that we have are pretty straightforward. Why don't we simulate some artificial market? So what we did is we simulated 50,000 contracts, which is a bit bigger than our sample. And then we have, let's say, observed true probability. So this beta distribution puts more weights to the tail. So it's still bounded between 0 and 1, but it's not like a uniform. It puts a bit more weights on the tails. And then we also simulate the resolution as a binomial. So pretty straightforward. And we also simulate, and some of these numbers, I know they are arbitrary, but what we wanted to do is like just come up with a simulation to run the regressions and coming up with the figures. Just to allow time for questions, Diego, if you have for the next 5 minutes or something. Okay, sounds good. So with the simulated data, it looked very, very similar to the actual data in this figure. And when we run the regressions look consistent. Of course, if I play a little bit with the parameters in the distribution, might look a bit different. But at least what we wanted to show you is that the specifications that we have, where we know we're simulating effects, appear to be are consistent with the actual data. So to close, we have three counterfactuals. Okay, so given that we capture the behavioral premium, which is basically you observe the polymarket price, and we can come up with an estimated version of the true price based on Tversky and Kahneman, the key question would be, hey, why don't we estimate what would be the behavioral premium? So in our data set, the entire amount of money invested is about a bit more than $9 million. And then after adjusting for the behavioral premium, we have that there's a mispricing of about 165,000, which is a bit less than 2%. So also in theory, we can say, hey, yes, humans have this behavioral bias. Now, knowing that they have this behavioral bias, if we adjust the bias and place some bets, in theory, we should be able to make 1.78% of the money that we bet, given that we're supposed to be, we will correct this behavioral bias, right? But what this is also showing is that we might know about the bias. Probably some stock traders or some polymarket traders might also know about the bias. So this also showing us some limits to arbitrage, right? So the fact that the bias exists and it appears to be there and nobody was able to eliminate it, it's showing also that there is some limits to making the market fully efficient, right? The second counterfactor that we have is because we have some learning component, what if we force people to learn quickly? And then it's a bit arbitrary, but we basically, this tau, we said, okay, why don't we force people to learn 5 there quicker? And then if we force people to learn quickly, or like 5 there quicker, that reduces about 10% of the behavioral bias. So this is, I'm not exactly sure how to motivate this other than telling people, hey, the solution is 5 days earlier. So that's probably not very easy to motivate. But this is like saying, hey, the game between Ghana and England is going to be played 5 days earlier, something like that. Or all else equal, you're jumping 5 days ahead of time. Other than this motivation that is difficult to explain, the key idea would be if you cut tau to be 5 days shorter, we do have some reduction in the behavioral bias. And the last counterfactor that we have, which we believe is the most interesting, is what if we have some inside trading? So I'm not sure if you're aware of this example, but there was the US administration going into Venezuela and taking over Maduro, right? And then about an hour before the US administration went into Venezuela and take out Maduro, there was a bet in Polymarket that was about $30,000. And guess what? The person won $400,000. And then people were looking at, and because this is all transparent, all documented, they go, wait a minute, this is not random. I mean, how can you go to Polymarket, place a bet, and then an hour later you pocket $400,000? So huge scandal, and then Polymarket was on the news, inside trading. So that's the motivation here. And what eventually happened is that they caught the person. So the person closed account, everything was supposed to be anonymous, but of course Polymarket helped authorities, and they was able to find the person. The person was involved in the intelligence behind capturing Maduro, which is a huge problem, because if you're Maduro, or if you're now in Rwanda, then what would you do? Look at Polymarket, right? It's a jump price. It's like they're after you, they're going after you, right? So people can also look at Polymarket price, not only to predict outcome, but you can look at the Polymarket price to see if you're in danger, right? So if you're Maduro, like next time around, like make sure you're keeping track of Polymarket price. But anyway, they caught the person. So inside trading is a huge deal here, right? So if you're a soccer player, and your game, I mean, if you're playing, you might have incentives to place a big bet and score against your own team, and that might be a way to like make lots of money. Like probably you might lose your job, but if you put a big enough bet, it might compensate, right? So there is a chance of people manipulating outcomes, or people who have, let's say, if you're working on Amazon, if you're one of the family members of the CEO of Amazon, they keep track of your account, so probably you won't be able to buy and sell on the stock market, but you might be able to buy and sell on Polymarket, right? So there is a possibility of inside trading. So what we do here is, given that we know the realization 0-1, why don't we simulate a proportion of traders that know exactly what the outcome is. So now we have this adjusted Polymarket price, where a share, lambda, of the traders know exactly what the outcome is. So it's pretty easy to do it. So we just generate the price again with a share of traders knowing exactly what the final price is. So running iterations again, we simulate with 2.5% of inside traders. So that's column 1, 5% of inside traders, and 7.5% of inside traders. So what we find is the Polymarket price, of course, becomes closer to 1, right? So what this is showing, of course, the 2.5, 5, and 7.5 are arbitrary. But what we're showing is that as the share of inside trading goes up, the Polymarket price, the marginal effect, close to 1, right? So which is pretty obvious. And the information that is coming from Black-Scholes decreases to near 0. So it's also giving us not only that, yes, inside traders come with information, but also it's telling us that you don't really, they're probably less than 10% of inside traders in terms of volume. It's enough to make the Polymarket price have all the information needed, and you don't need the information from the stock market anymore. And when we look at this dominance, complementarity, and parity, I think we're rejecting all three, right? Because it's basically the information parity doesn't hold anymore because the poly market price now contains all the information. And that's it. I think that the rest would be, conclusion would be like a summary of what we have. I don't know if we can focus more on like discussions and if you have any ideas to implement this on sporting events.
Yeah, thank you, Diego. And there's 10 minutes or so for questions. So questions here and questions online. If you raise your hand online, I will be looking out for you. Stephen, go on.
So just on that last bit, what penetration of insider trading would generate the level of informativeness that you actually observe in the data? Because you could simulate lots of different values, and obviously 2.5% is sort of like obviously more insiders than produce the pattern that you actually see. But can you sort of go lower and until you match?
Oh, like if you want to match these two numbers, or
I mean, match those to what you actually see in the data.
yeah, so I think we can play with we can play with lambda. What we were trying to do in this part was to increase it. I was picking like arbitrary numbers. So one would be to completely shift out the Black-Scholes price, right? The other one would be if this gets closer to 1, or probably exactly close to 1. What we can do is like maybe like do like a sensitivity analysis and keep going up until this exactly matches 1, and then probably increase it until this exactly matches 0, right? So we can also do that. Like what other ideas would you have to, let's say?
No, I mean keep reducing lambda until those rows match the ones that come out of the data set.
Oh, okay. So if we reduce it, eventually we'll get back to the previous regression, right? So in 0, we would match the previous regression.
Oh, okay.
Yeah.
So it's I see.
Yeah, if lambda is 0, we're going back to, let's say, if this is 0 and this is 0, we're back to the poly market price. In this one, we're already adjusting with this one, right? But if we go back to 0, we eventually get back to the poly market price, right?
Gotcha.
Yeah. But let me think about inside traders.
There's work by Shin. You've seen these papers by Shin. I think they were in the Economic Journal in the early 1990s on the insider trading and how that improves pricing. Because that's one thing that I think would be really interesting here, I guess. I think the other one is that in sport, of course, there's lots of insider information, and people are quite often trading on that insider information because if you happen to work at the stables that the horses are at and they're then going to be racing the next weekend. You know this information. If you live near the football stadium, you see the star striker hobbling out, rather than walking freely. There's lots of insider information in sport. So I mean, I think there is potentially quite interesting there in that that insider trading must drive price discovery, I guess, in sports markets, perhaps more than it does in other markets where there's actually laws against insider trading.
If you're like some inside trader, probably you want to know how much can I trade before I get caught, right? So the problem with the guy who bet again, I mean,
that's true.
But Maduro he made too much money, right?
Yeah.
His bet would have been like smaller, but he was never going to get caught, right? So the problem was betting too much. Oh, these betting markets are interesting because there's essentially fish and there's sharks, right? So it works as long as sophisticated traders are able to eat small fish. And the small fish are basically just traders who are losing money. Because again, it's not a stock market with probably, if you buy and hold, eventually Facebook becomes bigger or Amazon keeps growing and eventually you make money. here's like, if you're making money, someone else is losing. So if you're a shark, you want to make sure there's always enough fish, right? Because if you're an inside trader and you keep eating fish, eventually all the small fish won't be there anymore, right? And then they're gonna say, hey, why would I bet if I keep losing, right? So this inside trader, this is like more like a static version, but if we constantly move over the months and do the same exercise, you don't want to abuse the system because this is a headache for this. All fish disappear. So that's why Polymarket helped find this person was behind the inside trading, because this is terrible for business, right? You don't want to have these betting markets with the perception that there's inside trading, right? Yeah.
Any questions online? No hands at the moment.
So in sports, let's say you have information flowing all the time, right?
Well, there's a very interesting case that just kind of sprung to mind when you were talking about that, which is that at the end of the season just gone, in the Championship, the division below the Premier League, one of the teams that made it to the playoffs was then found to have been spying on other teams.
Mm-hmm.
So actually, there's photos of this guy that was sent, some young intern to go and spy on the opposition training sessions. And it wasn't the first time they've done it, on many occasions. So that says that training sessions are, widely available. So, therefore there could be lots of people doing that. All of the, I guess, kind of related again is that the way in which flash scores, like mobile phone apps, the way in which they update it, they just have someone sat by the side of the court getting the information that little bit faster than BBC gets the information, which presumably again is that kind of idea of the flow of information. And if you get it faster, then you win in some respect. Danielle's got his hand up though. That was just a comment. I wasn't going anywhere with that, other than just to kind of think out loud a little bit about that insider trading aspect in sport.
Yeah, what I like about this sports betting is that it's still very early, right? So all of the things that are already too mature in the stock market, they're still early, and there's a lot of effects like this behavioral element. You won't see it in the stock market anymore, because these are like people who are trading here are not as sophisticated as the ones that are showing up and trading in let's say the stock market. Yeah. So there's a lot of opportunities here that are, especially if you're looking at in behavioral econ, there might be like some other elements there.
Yeah. Daniel's got his hand up for one last question before we wrap up.
Oh, I actually had a comment and a question. So one is on the insider trading. There was actually a Spanish team that was involved in the relegation fight this year. And apparently they placed a large bet on Polymarket, betting that they would be relegated. And the interpretation, the comments that I read, well, they were just hedging, right? If they're relegated, they're going to lose a lot of money. Well, at least they're going to make sort of, the press described it as an insurance contract, which I thought was like quite outrageous, because that seems like a real sort of violation of sort of sporting integrity, that they would bet against themselves. In the end, they did not. They won the last match and did not get relegated, so it was interesting. But you can read in the, I think it was maybe Almeria, I can't remember exactly. It was in the Spanish first division, so it's like it's pretty high profile event. I want to comment something. I don't know if I can share a screen. Let me try and share a screen. I don't know if that works.
You should be able to sit here, right?
Can you see my screen?
Go back to here. Yes, I think you can, Daniel. Yeah.
Yeah. So on this sort of behavioral traders, so maybe my prior, I'm not a finance guy, so my prior is not that markets are perfectly efficient. I view myself as a behavioral economist. And I'm actually shocked at how efficient the markets are. So here is the poly market price of a World Cup match between France and Senegal. Okay, just played a couple of days ago. And if you see, there's this weird spike here, right? Can you see this? Around the, I think, 70th minute. So can you guess what happened?
France scored.
No. France was awarded a penalty, which was then called off by VAR. So you have this, immediate reaction to the penalty that, really spikes up the probability of France winning. And then, immediately, within a couple of minutes, the referee goes to the screen and says, no, it was no penalty. And so the probability goes back to what it was before. And then France scores a few minutes later, and then the price goes up. And the way that, I don't know if these are sort of, the sharks, like, the big, gambling people who are, manipulating these prices, or, or if these are sort of, casual, poly market traders. I view this as, strong support for the, efficient markets, that, the market corrects itself really instantaneously and sort of incorporates new information very quickly. And you see this all the time. That's why my first question was about sort of the frequency of the data, because, you started by talking about the, sports events. And in sports events, there are these, immediate, events that immediately sort of, change the probability that the outcome will resolve in one way or another. And yeah, I don't know. That's just a general comment. So I'm going to stop sharing.
Yeah, my data set it's not as good as this one. The one that you're showing, it's like very, very quick. Probably if you
So this was just
bar,
like the actual price.
that you want to place a bet before releasing the information, right?
Well, you quoted my paper in your presentation, Diego. We had lots of plots like that, Daniele, but from 15 years ago, before VAR. So we had lots of those big jumps when a goal happens.
Right.
None of the jumping
But
back down.
the VAR thing,
VAR's overturned
it's yeah, no, I thought it's striking. Yeah, no, so the goals, yes, information reacts sort of, instantaneously when there are goals. It also reacts, I think, a little bit sort of to red cards and other events in soccer. And soccer, I think, is quite unique that the goals are rare. So every goal really changes the probability by a big amount. In basketball, okay, you hit a 3-point shot, it moves your probability of winning by a little bit, but most of the shifts are quite small. So this is just sort of a general comment that, my impression is that in this context, it seems as if, maybe there is a favorite long shot bias sort of in, pre-odds, pre-kickoff odds. I would be, totally, I would totally believe that there is, but, when the in-game probabilities, they seem, the prices seem to react very, very quickly.
Great. Thank you, Danny. Thank you, everyone here and online. We will wrap up the next ROSES seminars in 2 weeks' time. That's another thing next week. So I look forward to seeing everyone there. Thank you.
Thank you, everybody. Thank you for coming, and everybody online.
And see you all soon.